If you own real estate in Fairfax County, then this February Market Insight is just for you. I'm Melvin Yates, your neighborhood real estate broker with EXIT Flagship Realty. On this month's Real Estate Market Insight, as always, we'll give you the real estate facts, not fluff. I'm going to share the 5 things you need to know about your neighborhood that are affecting your home's value this month. Plus, I've got the national data if you want the inside scoop on where things are headed. Don't forget to like and subscribe so I can continue to bring you the latest and most accurate real estate data specific to your neighborhood. My office has over 160 awesome realtors serving clients like you in DC, Maryland, and Virginia, so we can definitely help you put a real estate game plan together. Now for the numbers. Last month, the average sales price in Fairfax County was $710,626. This is a 9.6% increase over the last 12 months and a 0.3% increase over the last 30 days. So to put that in perspective, if you purchased a home in Fairfax County a year ago for, say, $700,000, on average, your home appreciated by about $70,000. Not bad. The average days on market, that's the time it takes to find a buyer in Fairfax, was 33 days last month. Over the month, we had 968 homes come to market for sale. However, we still only have about 1 week of total inventory in all of Fairfax County, which means that there's greater demand than there is supply. Though this may seem slightly challenging for my buyers as interest rates start to rise, for that same reason, my sellers should put a game plan together right now to ensure they capitalize at the right time. What that means is right now, buyers have a lot of buying power with historically low interest rates that enable them to afford a higher price point. Everyone should be paying close attention. As far as home sellers who accepted an offer during the month, otherwise known as pending, there were 966 of them, and they represented 100% of the 968 new listings that even came on the market for sale. There were 817 homes that ultimately did sell last month in all of Fairfax County. That's down 39.4% over the prior month and down 19% over last year this time. But as the data shows, there just aren't enough homes for sale in Fairfax County. Before I get into the national data reports, make sure you like and subscribe. Feel free to use the link to get an estimate of value from our website, or just text me an address and I'll shoot you a free market analysis. As always, you can text, call, or email me anytime. Thank you for trusting me as your source for accurate local real estate information, and I'll continue to work at being the most educated advisor on real estate topics in DC, Maryland, and Virginia. Now for the national data. We're going to be walking you through 3 of the most important topics in the housing market right now. We'll be talking about homeownership as a hedge against inflation, rising mortgage rates, and the latest update that we have on forbearance. So I'm going to begin with the first topic. Homeownership as a hedge against inflation. Now, why is that important for us to be talking about? Well, you know, as prices rise around us at the gas pump, at the grocery store, homeownership is certainly not immune to that in any way, and neither is rising rent. We're going to talk about that as well. But one of the things that we want to focus on is how locking in your fixed monthly costs, the mortgage payment, at today's rate is so beneficial to safeguarding you by hedging against that inflation and that rising cost that's going forward, for all of us. Now, I want to begin with a quote first from Investopedia. It says, "Real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns. Unlike paper assets, more specifically, as prices rise, so do property values." So what we see here is that homeownership is one of those things that you can lock in the cost today. It's an asset that's increasing in value over time, and as prices rise, home values rise, and all prices around us rise, locking in that fixed cost in homeownership is really game-changing as a hedge against inflation tomorrow. So what I want you to do on this next slide is get a visual, and you can see what really depicts what we're talking about. Homeownership outperforming inflation over time. Now this slide, as you can see, shows homeownership as a hedge against inflation, so let's break it down. This is home price appreciation versus the consumer price increases over the decades, and it goes all the way back to the 1970s. The blue bars are average inflation rate for the decade, and the green bars are the average home price appreciation for each of those decades. So as you see, starting with the 1970s, inflation increased at 7.1% and home values appreciated at 9.9%. So you can see that in the same time period. So home ownership outperformed inflation in that decade. And where do you want to be in inflationary times like we're in now? In assets that outperform inflation, obviously, right? Now, if you look at the 80s, it was a little bit more balanced, 5.6% inflation, 5.5% home price appreciation. Look at the 90s, we start to see home prices, tick up a little bit more, outperforming inflation throughout the 90s, throughout that decade. And now we know that the 2000s, as we all remember, or if you remember, were quite different. Home prices performed at a very different rate, than what we've seen in many of the other decades, even what we're seeing today and potentially tomorrow. We had a fundamentally different housing market. We had an oversupply of homes. We had lending standards that were different than they are today. Homeowners didn't have that equity that they have in their homes right now. So fundamentally a very different market. We're not seeing that going forward. So home prices did not outperform inflation in the 2000s. But look at the 2010s, and you'll see where home values really start to kick up again. And homes start to appreciate much faster than inflation, 4.9% versus 1.8%. I mean, that's huge. And then in the 2020s, in 2020 and 21, I guess what we're in now, you see what's happening right now. Massive home price appreciation, a drastic difference where home values outperform inflation. So as you can see over time is that home ownership is generally looked at as this great hedge against inflation because home values are performing better than the inflation rate. And that means that someone buying a home today can lock in today's cost and protect themselves against the rising cost of inflation in that biggest monthly payment going forward. Now, this becomes really important when we talk about renting because renting takes on the risk of obviously rising rent prices year after year after year after year. As we know, rental prices are skyrocketing. Let's take a look at this quote from Bankrate, and it says, "A fixed rate mortgage allows you to maintain the biggest portion of housing expenses at the same payment. Sure, property taxes will rise and other expenses may come up, but your monthly housing payment remains the same." Now, that's certainly not the case if you're renting. That's because rental prices, as you know, rise year after year. So this becomes really powerful for someone who might be sitting here going, I could buy today, but I'm gonna kind of, press pause and I'm gonna wait and see what happens to home values. They might go up, they might go down, I don't know. Well, all the forecasts that we've seen and that we've been sharing with you guys show that house values are projected to continue rising, as they have always continued rising over time. There may be dips, but over time they always do rise. We also know that mortgage rates are projected to keep rising, and we know that rental prices are rising. So what does that mean at the end of the day? Someone who continues to rent but could buy is taking on all that additional increase in rent year after year, plus it's going to cost more to buy a home down the road. So let's look at this next slide, which shows how rental prices compare with the inflation rate. This shows that rent increases have been greater than inflation in most years, not all years, but most years. So this going all the way back to the 70s. So your blue line, that's core inflation rate, and your green line is the rental price appreciation. And as you can see, the green line is higher than the blue line in most scenarios, meaning that rental prices have increased at a faster rate than inflation in most times. Again, not all times, but in most times. Let's look at this quote from Forbes. "Homeowners are shielded from mounting rental prices because their cost is fixed, regardless of what happens in the market. They're locking in their payment at today's cost. Tangible assets like real estate get more valuable over time." You've seen that in the graphs and the data that we've shown you, which makes buying a home a good way to spend your money during inflationary time. Now, we've talked a lot about home price appreciations, so let's take a look at this next graph from Home Price Expectation Surveys of Experts. Now, this is a survey of 100 data analysts who are projecting out how home prices will appreciate in the coming years. Now, in the fourth quarter of last year, this is their projection. This was the fourth quarter of last year, a couple months ago, this is their projection. By 2026 for cumulative house appreciation. And what they did is they divided the group into optimists and pessimists. So optimists obviously projecting the most appreciation over the next 5 years, and pessimists estimating on the lower side. So take a look at that orange bar. Those are the pessimists. The experts that are saying that home price appreciation on the lower side, cumulative by 2026 is going to be over 23%. So as experts look forward, the condition of the market, what's projected to happen? Home values are expected to increase in values over time. Even on the low side at 23.7%, it's pretty significant over the next 5 years. So locking in today's cost is mission critical for those who have the opportunity to do so. With home prices rising, mortgage rates rising, inflation all around us, it's going to get more expensive to purchase a home. Now let's talk a little bit about mortgage rates. We've seen a rise in mortgage rates in a volatile environment. So let's start right here. Sam Cater from Freddie Mac says, mortgage rates remain unchanged from last week. The economy lost momentum in January, leaving mortgage rates unchanged from last week and relatively flat for the third consecutive week. This stagnation reflects the economic impact of the Omicron variant of COVID-19, which we believe will subside in the coming months. As economic recovery continues going into the spring and summer, mortgage rates are expected to resume their upward trajectory. In the meantime, recent data suggests that homebuyer demand continues to be elevated as supply remains low, driving higher home prices. Now, this statement came out the day before the jobs report last Friday, and certainly I think a positive jobs report hints to the Fed to take action and raise the Fed funds rate in March. Expect to see rates go up. Now, we're at about 3.55% on the average 30-year fixed, as recorded by Freddie Mac, but no doubt a volatile January heading into February that I believe we'll see more rise in rates, and that's what we want to be prepared for. So if we look at this rise in rates, we're at about 3.55%. This graphic goes back to the beginning of 2020, and we're starting to get back to the area of where we started when the pandemic came upon us in March of 2020. Just to put that in perspective, the Fed comes in and acts as the influence. They don't control mortgage rates, but they do influence the rates, and now the rates are coming back up. Certainly a sign that we can all hope for, that the economy is improving and that we're going to get through this. We're moving ahead. So if you take a little bit larger look and you go back to the beginning of 2018, which is what this graphic shows on the average 30-year fixed, and sort of make this line, across at 3.55%. You can see where we sit, right? Certainly we're higher back in 2018 and 2019 and starting coming down and dropped to historic lows during the pandemic. And just now we're starting to come back out of it. This is again from Freddie Mac. As mortgage rates rise, we do expect some moderation in housing demand, causing house price growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory homes for sale should keep the housing market competitive. So based on that, sounds like we'll see a housing market that is competitive this year. Now it goes on to say, in 2022, we expect purchase originations to grow from 1.9 trillion in 2021 to 2.1 trillion in 2022, while refinance activity is anticipated to decrease from 2.7 trillion in 2021 to 1.2 trillion in 2022. Why is this important? Look at the two mortgage markets. You have the purchase market and the refinance market. Purchase market is forecasted to grow, while the refinance market is forecasted to constrict. And that makes sense, right? In a rising rate environment, everybody had the chance, to refinance. Well, maybe not everybody, but there will still be refinances in the future, but most people refinance at record low rates, and we're going to see the volume of those refinances constrict. If you take this rate of 3.55% and even going into 4%, which I think we'll see very soon, and that's still a very, very favorable rate. When you go all the way back to the 70s, this is the average 30-year fixed by decade, going back to 1970, 1980, 90, 2000, 2010. And what do you see there? At 3.55% or even 4%, very, very favorable financing. When you look historically, I've mentioned it before, between 2010 and 2020, we bounced between 3.5% and 5%, which was the range of interest rates during that time. And you see the average rate here, this decade is 4.09%. Very, very good financing. So it's going to feel like we're headed to higher rates, but when we look historically, there's still very, very good financing for homes across the country. Now, this is what we're looking at regarding the rate conversation. This is the 10-year Treasury yield going back to the beginning of December, just 2 months ago. And what do we know? During that time, the rate on the 10-year Treasury yield has skyrocketed, knocking on the door of 2%. Why is this important? For the last 50 years, the relationship between the mortgage rate and the 10-year Treasury yield has been almost exactly in step, as you can see. Wherever the 10-year Treasury yield goes, there goes the 30-year fixed rate. The Fed raising rates does not control interest rates, as we said earlier. It can only hope to influence it. So what we want to watch really is the 10-year Treasury yield. Now let's check out this next slide. Mortgage rates hit their highest level since March of 2020. leading to the slowest pace of refinance activity in over 2 years. Now, the last topic for today is our latest update on forbearance. This is something we've been following and sharing with you for a while now, and today's data is really going to help articulate why we will not see a wave of foreclosures coming to the market. Let's begin with an update on how many loans are in the forbearance program. Take a look at this graph right here. Loans in the forbearance have fallen below 1 million. This is massive. We're roughly at 780,000 loans in forbearance today, and that equates to only 1.4% of all mortgages. So if you think about where we started, over there in the red bars on the left, you'll see we're nearly 5 million homes in the forbearance program in May of 2020, and now we're down to about 780,000. So huge progress. Just one more way to show that the forbearance program has really helped homeowners change their situation, stay in their homes, and be in a much better place in these economically uncertain times. This is vastly different, obviously, than what we saw in the 2008 time. So I want to share a quote with you from Black Knight that says, "As the COVID-19 pandemic continues to create uncertainty in the global economy, the overwhelming majority, 89% of single-family homeowners who sought financial assistance through COVID-related mortgage payment forbearance plans have exited those plans." So many people, 89% of people who went into the forbearance plan have exited, and that is massive improvement. Let me remind you that 9.3 million homes went into foreclosure the last time around when the housing bubble burst in the 07-08 time. And we're in a very, very different situation now based on the data. So just remember that 9.3 million number as we look back at as we look at the last slide. What it says here is that there are 422,360 fewer foreclosures over the last 2 years. So we have significantly fewer foreclosures today than we would even have in a normal year. Now let me break it down. So look at those first red bars, the taller ones to the left. That's 2017, 18, and 19. The number of foreclosures we had in those normal years leading up to the pandemic averaged just under 300,000. 300,000 foreclosures. You can see that last year we were thankfully much, much less than that. I hope you enjoyed this county and national real estate market insight. Please like and subscribe if you haven't already. Feel free to use the link to get an estimate of value from our website, or just text me an address and I'll shoot over a free market analysis. Thank you for watching, and we'll talk soon.